While everyone was celebrating silver's crash back to $65,000 and calling it the end of the bubble, the vaults in London reported their largest single-week outflow in recorded history. Not large, largest. 47 million ounces gone in 72 hours. And the delivery addresses were not Wall Street. They were Shanghai, Mumbai, and Dubai. Someone with nation-state level capital was buying the fear, and the footprint they left in the data does not suggest silver is going higher. It mathematically demands it. Because what I uncovered this week is not a prediction. It is a pattern that has executed twice before with surgical precision. And both times, the people who recognized it in real time retired early. The people who dismissed it spent the next decade explaining to their families why they missed it. By the time you finish listening to this, you will understand why $300 silver by summer 2026 is not hype. It is the inevitable conclusion of a 50-year pressure system that has finally ruptured. And you are watching it happen in real time, whether you realize it or not. Let me show you something that will completely reframe how you see this market. Silver just broke above $50 for the first time in half a century. Not 10 years, not 20 years, 50 years. From 1980 to 2025, silver was locked in a tomb between $4 and $50. Every single attempt to escape that range was crushed. 1980 rejected at the ceiling. 2011 slammed back down at $50. For 5 decades, the entire financial establishment treated that range as gospel. Silver is a $50 metal. That is what every textbook said. That is what every analyst on CNBC repeated. That is what your financial advisor told you when you asked about precious metals. But here is what they did not tell you. During those exact same 50 years, gold did not stay trapped. Gold obliterated its 1980 high. Gold smashed through its 2011 high. Gold kept making new all-time highs decade after decade while silver sat in a cage. Copper did the same thing. Copper traded between 50 cents and $1.50 for decades, and then in 2006 it broke out and went to $4.50. Lead did it in 2007. Zinc did it in 2006. Every single major commodity that was compressed in a multi-decade range eventually broke free and repriced violently higher. Every single one except silver. For 50 years, silver was the only major commodity held below its historical breakout level. You need to understand what that means. It means the energy that built up inside this market over 5 decades is now releasing. And when half a century of suppressed price discovery finally breaks loose, it does not move 15%. It does not move 50%. It moves in multiples. That is not my opinion. That is what the chart is screaming at anyone willing to look. Now let me show you the pattern that changed everything for me. I went back and pulled every major silver surge in the modern era, and what I found was so consistent, it made me question whether I was looking at the same asset or 3 different versions of the same script. 1979 to 1980. Silver went from roughly $12 to $50. It more than quadrupled. And the entire move happened in 5 months, not 5 years. 5 months, 2010 to 2011, silver went from $18 to just under $50. It nearly tripled. And it did it in 7 months. Both surges happened within a single year. The explosive phase, the part where generational wealth gets created, happens fast. And here is the part that separates the winners from the losers. Both times, there was a brutal shakeout in the middle. A sharp, violent correction that made every holder question their sanity. A jiggle that looked like the top. A pullback that convinced the majority that the rally was over and they should sell before it got worse. And both times, that correction was the final gift. The last chance to position before the real acceleration. Now look at what just happened. Silver started its breakout surge in November 2025, month 1. December, month 2. By the end of January, silver had rocketed past $90 and the entire financial media was screaming bubble. Then came the crash, a sickening, brutal collapse that took silver from $90 back down in a day and a half and made every single person holding silver feel like an idiot. Sound familiar? It should, because this is the exact same pattern. Month 1, month 2, violent shakeout. And if the pattern holds, and it has held twice before with terrifying precision, the real move has not even started yet. The majority of the gain, the phase where silver goes from here to $300 or higher, happens in months 3 through 6. That window opens right now and closes in early summer 2026. But here is where this gets completely insane. And this is the difference between this cycle and everything that came before. In 1980, silver quadrupled inside the old $50 ceiling. The surge was powerful, but it stayed within the boundaries of the established range. In 2011, same thing. Silver doubled, but hit that $50 wall again and got destroyed. Both moves were violent, but both were contained within the old reality. This time, silver has already broken through the 50-year ceiling. The old reality is gone. The $50 cap that held for half a century has been shattered. And even after that horrific crash, silver did not fall back below $50. It held above the old range. Do you see what that means? The floor of the new reality is the ceiling of the old one. Silver is not going back to the old world. It is building a launch pad on top of it. Think of it like a dam. For 50 years, water has been accumulating behind a concrete barrier. Pressure building every single year. Every decade, the water level rises. Every attempt to breach the wall gets pushed back, but the water never drains. It just keeps building. And now, for the first time in 50 years, the wall has cracked. The water is not going to politely trickle through. It is going to explode through with 50 years of accumulated force behind it. That is what is happening to silver right now. The dam is cracked and there is no putting it back together. Not with central bank intervention, not with margin hikes, not with media propaganda. The break has happened. Now I want to talk about something that is costing people a fortune and almost nobody is talking about it. After the crash from $90, I watched dozens of prominent voices in the precious metals community announce that they sold their entire position at the top. They pointed to their RSI indicators, their momentum oscillators, their overbought readings on the weekly chart, and said silver was overextended and due for a major correction. And technically, they were correct. A correction did happen. But here's the problem. They are using tools designed for the old range to measure a new reality. It is like trying to measure a nuclear explosion with a thermometer built for your living room. The instrument was not designed for this environment. RSI hitting 80 or 90 on a monthly chart used to mean overbought. Used to. In the old range, when silver was confined between $4 and $50, those readings were reliable signals. But we are not in that range anymore. I pulled the annual momentum charts, and silver has already blown past the momentum levels that marked the 2011 top and the 2020 high. The old ceiling on momentum has been shattered just like the old ceiling on price. Which means anyone using legacy overbought metrics to time an exit is going to miss the largest move of their lives. And here's the cruelest part. Once they sell, the psychological barrier to re-entering at a higher price becomes insurmountable. Most of them will never get back in. They will sit on the sidelines and watch silver do exactly what copper did after its multi-decade breakout. They will be right about the correction and catastrophically wrong about the trend. Let me tell you who's watching this video right now. There are three groups. The first group sold during the crash and is desperately hoping I am wrong so they can feel vindicated. The second group held through the pain and is searching for confirmation that they are not insane. And the third group has been waiting on the sidelines for the perfect entry and is now starting to realize that the perfect entry might have already passed. Whichever group you belong to, the data does not care about your emotions. It only cares about the pattern. And the pattern says we are in month 2 of a 5 to 7 month surge that historically produces triple-digit percentage gains. Not might produce, historically produces. Now, let me show you something that mainstream financial media will never touch. And this is the part that sent me down a rabbit hole I was not expecting. I pulled the Shanghai silver price and compared it to the New York COMEX price. There's a $30 gap. Shanghai silver is trading $30 per ounce higher than the Western paper price. $30. That is not a glitch. That is not a temporary dislocation. That is the physical market telling you in screaming neon letters that the paper price is a fiction. Go ahead and verify this yourself right now. Pull up Shanghai silver premium on any search engine. Look at the number with your own eyes, because when you see it on a screen that is not mine, it hits different. That gap is real, and it is widening every single week. In my previous breakdown, I showed you that China implemented export controls on silver effective January 1st, 2026. Only 44 state-approved companies are allowed to export. 60 to 70% of global refined silver supply is now locked inside Chinese borders. And the result is a $30 premium in the Shanghai market. But it is not just China. I have been tracking reports from bullion dealers across North America and Europe. Some of them are now warning clients that they may receive $10 to $15 below spot price on physical silver sales because the dealers cannot source enough inventory to meet demand at current market prices. Read that again. Dealers are telling customers in advance that they might not be able to honor the spot price. That is not a healthy market. That is a market where the price on your screen and the price in the real world are two completely different numbers. And every single time in history that physical premiums have exploded like this, the paper price eventually catches up to the physical reality. Not the other way around. The paper price always rises to meet the physical truth. It has never once worked in reverse. So when you see silver quoted at whatever the COMEX says today, understand that the actual price, the price at which real metal is changing hands in the world's largest manufacturing economy, is $30 or higher. That gap has to close. And it closes in only one direction. The Western price goes up. But that is not even the most important part. Let me explain something that most people completely misunderstand about silver. Silver rides on two waves. Most people think silver is an industrial metal, and they are half right. Silver goes into solar panels, artificial intelligence infrastructure, 5G networks, medical devices, electronics. China manufactures 80 to 90% of the world's solar cells, and silver is essential in every single panel. The global supply deficit has not been satisfied for 5 consecutive years. Demand has exceeded mine supply every single year since 2021. And here's the thing about industrial silver. Once it goes into a solar panel or a circuit board, it is gone forever. The quantities are too small to economically recycle. Every ounce used industrially is an ounce permanently removed from the available supply. That is wave 1. Industrial demand that is structurally unrelenting. Wave 2 is the one that changes everything. Silver is money. It has been money for 3,000 years. Not 300. 3,000. And right now, something extraordinary is happening that has not happened in over a century. India's Reserve Bank has issued formal regulations allowing silver to be used as bank collateral effective April 1st, 2026. That is the first official monetization of silver by a major economy since the 1800s. 1.4 billion people are about to gain institutional access to silver as a recognized monetary asset. This is not speculation. This is published regulatory fact from the Reserve Bank of India. And here is what makes this explosive. When silver functions only as an industrial commodity, its price is driven by factories and supply chains. Predictable, manageable. But when silver starts functioning as money, when 1.4 billion people begin treating it as a store of value and a hedge against currency debasement, the demand curve goes vertical. Gold has been riding this monetary wave for 2 decades. That is why gold keeps making new all-time highs while stocks go sideways. Gold is the anchor of the monetary system, but silver is gold's little brother. For 3,000 years, silver has followed gold with a lag, and right now, that lag is the widest it has been in modern history. Silver is absurdly undervalued relative to gold. The gold to silver ratio is still sitting near historically extreme levels. And every single time this ratio has stretched this far, silver has violently repriced higher to close the gap. Not gradually, violently. So you have 2 enormous demand waves converging at the exact same time. Industrial demand that has overwhelmed supply for 5 straight years, and monetary demand that is about to be unleashed across 1.4 billion people. Both waves hitting simultaneously. And the supply side is not expanding. It is contracting because China just locked 60 to 70% of the world's refined silver inside its borders. This is not a setup for a 10% rally. This is a setup for a paradigm shift. Now let me connect this to the broader financial landscape, because silver does not exist in isolation. And what I found here is what convinced me that $300 silver is not optimistic. It might actually be conservative. I pulled up the US dollar index going back to 2010. The long-term momentum trend is not bending. It is broken. The dollar has dropped below a structural support line that held for over a decade. The dollar is not collapsing overnight. It is a slow, grinding decay. But when you overlay the M2 money supply data, the picture becomes undeniable. Every single decade, the money supply increases by 80 to 90%. That is not conspiracy theory. That is Federal Reserve published data. Every 10 years, they print 80 to 90% more dollars into existence, which means the purchasing power of every dollar in your pocket drops decade after decade. And precious metals are the mirror image of that decay. When the dollar weakens structurally, gold and silver do not just go up a little bit. They reprice to reflect the cumulative loss of purchasing power that was hidden and suppressed during strong dollar periods. That repricing is happening right now in real time. But there's another factor, and this one should genuinely concern anyone paying attention. The government bond market is cracking. I pulled U.S. Treasury bond futures, and they are trading around 115 right now. Recent lows touched the 113 range, and here is the line that matters. If bonds drop another 3 points into the 112 area, the support structure that has kept bond prices stable since the 2022 collapse breaks down completely. And when that breaks, the United States bond market starts to look like Japan. Japan is already in full crisis mode with yield curve control and unlimited bond buying just to keep the market from imploding. The UK bond market is under severe stress. Government debt globally is at levels that are making even the most conservative institutional investors nervous. Jamie Dimon himself said months ago that we cannot keep kicking this down the road. When the average person who used to feel completely safe putting their money in government bonds starts to doubt that safety, that is not a small event. That is a nuclear detonation in the financial system. Because if you cannot trust government bonds, the safest asset in the traditional framework, where do you put your wealth? For 3,000 years, the answer to that question has been gold and silver. And that answer is coming back whether central banks like it or not. And here's what ties everything together. The entire commodity complex is breaking out. I pulled the Bloomberg Commodity Index, and it has broken above a massive multi-year consolidation base. Crude oil just triggered a technical breakout that ends the 2-year depression in energy prices. If crude goes from $60 to $90, and $90 is not even expensive by historical standards because we were at $130 in 2022, that represents a 50% increase in gasoline prices at the pump. Wheat has joined the breakout. Copper is making new highs. When commodity prices surge across the board, the average consumer gets crushed. Cost of living goes up. Inflation expectations spike, and the monetary metals, gold and silver, become the only logical shelter from the storm. And here is something that should terrify every stock market investor. I compared the S&P 500 to gold and silver over the last 4 to 5 months. The S&P is completely sideways. It has been banging its head against the 7,000 level and going absolutely nowhere. Meanwhile, gold and silver, even after their brutal corrections, are dramatically outperforming equities over the same time period. There's a massive rotation happening right now under the surface. Money is quietly leaving paper financial assets and flowing into hard assets, commodities, energy, land, and above all, precious metals. This is not a one-week anomaly. This rotation has been building for months, and when the average retail investor finally notices, which they always do dead last, the flood of capital into silver will be unlike anything we have seen in our lifetimes. Do you see what is happening here? Dollar breaking down, bonds cracking, commodities breaking out, stocks sideways, physical silver premiums at $30 above paper, industrial deficit for 5 consecutive years, India officially remonetizing silver, China locking supply inside its borders with export controls, vault inventories draining in London, New York, and Zurich. I have been studying markets for years, and I have never, not once, seen this many macro factors converging on a single asset at the same time. This is not one indicator pointing to higher silver. This is every single major structural signal pointing in the exact same direction simultaneously. Now let me give you the number that made me stop and take a very long pause. Gold made its cycle low in 2015 at roughly $10.50 per ounce. In previous precious metals bull markets, gold has delivered an 8-fold move from cycle low to cycle peak. The 1980 peak was an 8-fold rally from the base. The 2011 peak was an 8-fold move from its low. An 8-fold move from $10.50 puts gold at $8,400 per ounce. JP Morgan, one of the largest and most conservative banks on the planet, just published a price target of $8,500 for gold, the same number that the historical pattern produces independently. When one of the most powerful financial institutions in the world is publishing the exact same target that the mathematical pattern generates on its own, that is not coincidence, that is confirmation. And here is what that means for silver. If gold goes to 8,500 and the gold to silver ratio reverts even halfway back toward its long-term historical average, silver at $300 is not aggressive. It is the mathematical midpoint of the range. Silver at 500 becomes the upper boundary of what a full normalization would look like. And remember, the explosive acceleration phase of this move, based on the 1979 and 2010 precedents, happens within 5 to 7 months of the initial breakout. We are in month 2 right now. Month 2. Let me be completely transparent about the risks, because I am not here to sell you fantasy. I am here to show you pattern recognition applied to data. Silver is brutally volatile. The crash from $90 proved that beyond any doubt. If you're using leverage or margin, you can get completely wiped out on a correction, even if the long-term trend is in your favor. Mining stocks can drop 50% during a pullback, even in the middle of a raging bull market. Timing entries and exits is nearly impossible, and nobody gets it perfect. There are also scenarios where this pattern could break. If governments aggressively hike interest rates into a recession, if there is a massive deflationary shock that crashes all asset prices, if China reverses its export controls for geopolitical reasons, any of those events would weaken the thesis. I do not think any of them are likely based on the current macro setup, but they are possible. This is not financial advice. This is data analysis and historical pattern recognition. What you do with this information is entirely your decision and your responsibility. But here is what I keep coming back to. Let me paint the picture of what the next few months might look like if the pattern continues to hold. February is the stabilization phase, the consolidation month. Silver bounces, pulls back, bounces again. It feels frustrating. It feels like nothing is happening. The headlines say the rally is over, but underneath the surface, the structure is quietly rebuilding. The 3-month moving average holds as support. Short-term momentum buy signals start triggering on the weekly charts. If silver reclaims the upper 80s this month or next, the bears are in serious trouble because all the weak hands have already been shaken out. By March, if the pattern executes, silver challenges its recent highs again. And this is where the game changes forever. Because, the second time, silver approaches a major resistance level after purging all the overleveraged speculators and panic sellers, there is no overhead supply left. Everyone who was going to sell has already sold. The only participants left in the market are committed buyers, and that is when the real acceleration phase begins. March through June, that is the window. That is where the 1979 pattern delivered a 400% move. That is where the 2010 pattern produced a 250% surge, and this time, the launch point is not $12 or $18. The starting point is above the 50-year ceiling, above the level that capped silver for half a century, with every single macro indicator aligned, with physical premiums screaming that the real price is already far higher than the paper market shows, with vaults draining, with nations buying, with monetary policy in shambles and bond markets cracking under the weight of unsustainable debt. 5 years from now, you are going to look back at this exact moment. You will remember the crash from $90. You will remember the fear, the doubt, the nausea in your stomach, the headlines screaming that silver was done and the bubble had popped. And you will either remember it as the moment you panicked and sold at the bottom, or you will remember it as the moment you looked at the data, recognized the pattern, and made the decision that permanently changed your financial trajectory. Silver was imprisoned for 50 years. 50 years of compression. 50 years of every analyst and every textbook telling you it could never break above $50. And it broke. It shattered that ceiling. It destroyed the narrative. And even after the most vicious correction in years, silver has not gone back below the old range. The floor of the new reality is the ceiling of the old one. Same pattern, same sequence, same outcome. Not might happen, will happen. You cannot unsee it.